I'm happy that I'm seeing some faces here that I thought they would have jackpot, but they are still with us, so I'm happy. Okay, I was trying to say something as we started that the first thing that we need to do when you are trying to come back to form, because actually some of the things you learned there, they are still in your head though. The truth is that they are still in your head, but there are a lot of the cares of this world that has covered them. So what we want to try to do now is to just remove those cares and just bring them out so that you can now remember that, oh, these things are actually there. Even me, when I was coming to teach, I felt, what I want to do. I just shall believe that, okay, I know it will still be there. It's just for you to just kick the whole process starts. And once it starts, everything will start happening and you are good. You get so that's how it is. So we are going to start with financial accounting, but from the first part is, let's first of all even see the whole thing that we covered before, so that we can now start reviewing them one after the other. So we talked about depreciation, then we'll go to partnership accounts. Partnership accounts. Now, if you notice, I remove sole proprietor accounts because most times they don't test it in the exam. You get, so we just review partnership accounts. Then after partnership accounts, we have talked about control accounts. We go to company accounts. Company accounts. Then we look at ratio analysis. Yeah, so this basically is the context of where your exam will be set from. And for me, one of the secrets I will also share with you is, for this your exam, especially for corporate finance, by God's grace, I will do my own findings so that we don't need to do too much stress. But what I see your exam will be like, will be focused on last year past questions. Yes, for most of the courses, I will advise you guys, if you are reading most of the courses, focus on last year past questions. You get, and I believe most of the lecturers, especially for finance, they will just repeat those last year past questions. You get, we have seen from past incidents when issues like this occur, they just go to immediate year, last year, last 2 years past questions. They just, they might review it. Like finance, I believe finance would have not set their exam. Yes, I believe finance would have not set their exam. You get, so they don't set exam and go and give it to coordinator. They don't do that because they are not sure that thing will not look. It's only accounting that I'm sure that they would have sent it or they would have set it, because the lecturer that will set it in his office and carry it to MBA school most time on that day. You get, most time on that day. They don't set question and give it to MBA school. You get, it's the lecturer that will set his question on that. Most of them on that day, they will not carry it to MBA school on that day for printing. They will drop one in MBA school. You get, so basically this is the idea that we'll look at. And then the pattern of today's class, we'll just do touch. You get, so that we'll use to clean up what we have done before. Okay, so starting from the first touch, we'll look at, I believe you guys have taken, you already know this, so there's no need to write like that. So from the first touch, we talked about financial accounting as a process of what? A process of what? Collecting, recording, presenting, analyzing, and what? Interpreting of what? Of financial data, you get, in order to make what? Decision. You get, so the whole idea behind that concept of financial accounting most time is for you to be able to answer some objective questions, which by God's grace we'll review. Yeah, that's part of the touch we are going to do, so that we just start cleaning up our heads. Okay, so remember last class I also told you that when you I still remember last class. Remember last class call. Nobody will just be listening to remember last class. Remember then, we said when you collect financial accounting information, you use what? The source document. So source document is used in collecting what? Financial accounting information. You get? Then I remember also telling you that there are several source documents that you should actually know. You get? Why? Because you need the knowledge of these source documents in recording. Are you there? So with the knowledge of source documents and recording, you can be able to present your financial statement because you already have this basic foundation. So one of the source documents we said earlier was what? Receipts. Number 2 was what? Invoice. So invoice can be sales invoice or what? Purchase invoice. But please, if you know it as invoice, you should know that invoice can be sales or what? Or purchase. And anything that gets to do with invoice, they are usually on what? Credit sales or credit purchase. So anything invoice is on credits. Anything receipt is on what? Cash. You get? But most time, you'll see an Igbo man will give you invoice. If you have paid, they'll say, okay, take the receipt. The most time they miss invoice and receipts. But all of them are called what? Source documents. You get? Then another source document we also have there is what? We have debit notes. And we have what? Credit notes. So those are the basic source document that is very important you know. You get? Then from these source documents, you should also know each of them, their uses. For example, we say receipt is for what? Cash transaction. Sales invoice is for credit sales. Purchase invoice is for what? Credit purchase. Then debit notes is whenever you have return outward. You get? So return outward just from the way the word is return outward. So you have purchased an item from your supplier. And part of it, they were bad. So you now call, supplier, this thing is bad, though. You return. But don't forget, that purchase you made, it was done on what? On credit basis. So I repeat. For example, you have a supplier that supplies you marker. And you now call the supplier to supply you 10 cartons of marker. But I'm going to pay this guy in the future dates. The guy supplied you. You now discover that part of this marker, maybe 5 of the cartons were bad or were empty. You now call the guy, guy, come and pack this 5. You are returning outward. Now, by so doing, don't forget, you've purchased 10 cartons on credit, Abi? So it means, therefore, that you are owing the supplier. Hello? That's what it means. So this is the supplier. Because the knowledge of these two concepts will also guide you more when you start saying questions. You get? So this, yes, I'm with you.
You say you are owing the supplier.
Yes.
The supplier is owing you. Because he supplied you and find his bag, right? You're returning back to him.
Yes.
So he's going to owe you, not to owe you, right?
No, the first you missed the first instance. The first instance you didn't say it. So this is what you have said. This is the first instance I say you didn't say. You have purchased an item from the supplier worth 200 naira. On credit. Who is owing the supplier? It's you that is owing the supplier. So that's the first instance I said. Now, of which you now discover that an item worth 50 naira, they were bad. So you return outward back to the supplier. So what it means is that your liability that you are owing the supplier has reduced. So that's the concept of this debit note. So whenever you see the word debit note is showing you that you are reducing your liability to the supplier. Am I making sense there? So the same thing now, don't forget the business and the supplier that deals with debit notes. The business and the supplier that deals with debit notes. All those knowledge are very important because you see OBJ questions. The business and the supplier that deals with debit notes. Why? Because of credit purchase. Now, the business and the customer is the one that deal with what? Credit notes. Because credit notes is an evidence of return inward. So you sold goods to this guy, your customer, on credit worth 100 naira. I sold goods to a customer. The customer did not pay me. The business sold to the customer. Now the customer now said, Oga, goods worth 15 naira that you sold to me, they were bad. Oh. Don't forget, this sales was done on credit. So he now said, okay, let me return part of it. He returned the one of what? 15 naira. So how much is the customer owe you? It will now be what? 15 naira. So it means that the credit note is actually showing the liability of the customer to the business. That, oh, the liability of the customer to the business has what? Has reduced. So those are basic concepts. So anytime you see credit note, you know that it's the business with the customer. Anytime you see debit note, you know that it's a business with what? The supplier. So these are the 3 entities that you need to understand when you are dealing with financial accounting. So whenever you are having any complication in financial accounting concepts, just picture these 3 guys. Understand how they play. Then you see that you'll be able to make 1 or 2 trials to answer that question, especially in the OPG section. Okay, so now that brings us to when you say you are recording. Because see, the source document entails information that you will not carry to another book. Are you there? Called the subsidiary book. So the book of recording is known as the what? The subsidiary book. You get? So I'll be very fast on this segment so that we can move to OBG on this part. You get? Then move to another topic again. You get? So the book that is used for recording is known as what? Subsidiary book. So, and now the subsidiary book is also known as the book of what? Original entry. Some people call it a journal. You can call it journal. Subsidiary book can be called a journal. It's also known as a book of what? Original entry. So the whole idea behind this subsidiary book is just that it helps you to record all these items in the source document in an accounting form. How do I mean? Debits and credit form. You get? So a good example of subsidiary book is called cash what? Cash book. So all the items you collect from receipts as a source, you take it to where? To the cash book. Another important item there is the sales journal. This sales journal can also be called the sales day book. So take note of that. The sales journal can also be called the sales day book. So that day book there means that it's prepared every day because we make sales every day. Then the other one is called the purchase journal, which can also call the purchase what? Day book. You get? It's also a subsidiary book. Another one is called a purchase return journal or return outward journal based on debit notes. Return outward what? Journal. So the return outward journal is used for is you get information from debit notes into where? Return outward journal. You get? Then the next one there is what? Is return inward journal. So the information you get from your credit notes are what you bring in your return inward what? Journal. So who can tell me what are those kind of information you get in your debit notes? Starting from, if you are the business person and you have a book called debit notes, what are the items will you record in that note that you are going to carry into this place? Purchase bills. Let's, the idea is to unlock that cobwebs that has been in the head now. We want to remove it. So let me ask the question again. I've explained credit notes for us. So I'm not asking. You are a businessman and you have a credit note. Credit notes. What are the items that you will encode in that credit note that you are not going to carry into a return inward journal? Quantity of goods. I don't know how I just asked that question, but I think the question makes sense now to me because it will help me to tell you some other things. Details of the customer, like what? Name of the customer good. Goods return. Okay, now I like the answers you guys are giving me. It wants to make me now go deeper to explain some things. Now, accounting books, if you have quantity there and you don't have value, it's not relevant. Any accounting transaction that is not monetized, is not in money form, go and throw it away. They can't use it for anything. So one of the most important items, you said quantity, but you'd have said quantity as well as the value of the item that is returned. Because it's value of the item that you will not know how much that will be left for you to pay. So you also said the name of the customer. Yes, you get the name of the customer, the date of return, and the date of previous transaction. Because those are information that the bookkeeper will now put in place to be able to now document for this new activity. You understand what I'm saying? Okay, so it's a good one. So apart from, now see, all the things we have said now is centered around day book. What you do, your transaction every day. Am I making sense? But there are some transactions you don't do every day that sometimes they occur. Either some of them might be the depreciation or wear and tear of your machine. You get? You don't do that every day. But it's a transaction that you must document or record. So the book you use in recording that, they call it general what? Journal. Or you call it journal proper. You get? So those are basic books that I need us to start understanding and get used to. You get? For this new phase of our class. Now, outside all of this, there's need for us to understand that for you to record into this book, you must understand the concept of the double entry rules. And I believe I gave you 2 rules that I want you to know. But most people that will teach you will just say double entry rule. But I want you to understand 2 basic rules. Now, one of the rules that I am concerned with, that I need you to understand, is the double entry, which they also call the duality concept. Are you there? Then another rule is the decil. Decil and what? Cadere. At least with this one now, some people will now realize, we resume. It will dawn on them that, seriously, class don't start again. So these are the 2 rules, and I said, okay, all my students should keep at the back of their hands, because sometimes you don't know where these things, especially the second one, can save you. You get? So we are going to talk about each of them one after the other. For the principle of double entry, what did I tell you? I said the principle states that for every debit entry, there must be what? A corresponding credit entry. It's a simple rule that, because we do it every day, for every time you take in, you must what? Give up. They say God in heaven is a most, in short, is a wonderful accountant. Because he knows that if you eat, the food will digest. And there should be a system in a man's body that should also take it out. You get? So, for every time you debit, which is you have received something, always know that you will take that thing out also. So nothing is permanent in life. That thing that we are holding, forget it will also go back. According to the songwriter Lucky Dube, when he said, blessed is the man that gives her, that song. You get? So if you hold on to something too much and you didn't let it out, it will spoil. So accounting rule is that whatsoever that you bring in, also have it to take out. So if you buy something has come in, Abi, that thing you buy, process it to something you can also sell to take it out. So debit everything that comes in. So if I receive cash, I'm debiting myself. If I paid cash, I'm crediting myself. Abi? No. Then also, I say you should debit anything that is plus to you. If it's addition, it's plus, debit it. But if it's subtraction, credit it. You get crediting. So those are key things that you use to understand how to debit and how to credit. So in a simple example, before we go into key things, in a simple example, for example, if I say Dove Consult, for example, I say Dove Consult purchase goods worth 50,000 naira cash. Dove Consult purchase goods worth 50,000 naira cash. So the two things you put in your mind first. Listen, remember that 3 human being I drew earlier. Are you there? Dove Consult in this case is standing as the what? The business. Dove Consult purchase goods worth how much cash? 50,000. Who did Dove Consult purchase it from? The supplier. Am I making sense? So the relationship is between the business and the supplier. So the first thing that will now come to your mind again is, okay, what are the 2 accounts that this transaction has? Dove Consult purchase goods. So purchase is a normal routine that Dove Consult does every time. So it means purchase account will be there. Don't say Dove account. What did Dove do? Purchase. The account is purchase account. Now, the next account you now look, okay, Dove purchase it with cash. Abi, it means that Dove has this cash somewhere, and Dove has an account for that cash. It means Dove Consult went and take that cash. So it means there should be a cash account that will also be created. So in that case, there are 2 accounts. What are they? Purchase account and what? And cash account. We've identified the account now. The second step will now be, okay, how much? Since Dove is purchasing, Abi, something is coming in. Am I making sense there? So it means we are to debit purchase account. Are we there? Okay, so we just have 10 minutes to close this first part. Then cash is going out, Abi. So what do we do to cash? We'll credit cash account. So see how we'll do it. Dove has purchased, something came in, Abi. Good. So what came in? What's the worth of what came in? Not the quantity, the worth. 50K, Abi. 50K. But in this case, you are going to title this 50K. Do you know what you title it with? With the other accounts that you have opened, which is 50,000 naira what? Cash. Cash, 50K. Now, you now go to cash account. Cash account is what? Credited. Why? Because something has left cash. So you now also come here, 50 what? 50K. But what's the name you use here? Is the name of the other account, which is what? Purchase. You get? So those are the 2 accounts that you will see for that transaction that just occurred. Am I making sense there? So those are accounts. Those are how you know the concept of debits in and what? And credits out. Are we together in this? Okay. Now, don't worry, as we go on, everything will be clear as we are going on. So just let's take it small. Now, the next part, before this section ends, the next part is the concept of DSIL and CADIL. So I just need you to note what each of these items means, and you are good. So D here means debit. E means expenses. A means assets. So this is the first phase. There, which is debit, expenses, and assets when they are increasing. You see the arrow that is going up. You are debiting expenses and assets when they are increasing. Then see the next one. C. Credits. I. Income. And L. Liabilities. When they are what? Increasing. So this first DSIL is looking at increase. You debit expenses and assets. When expenses is increasing, you debit. So if the business pays salary, it's not increasing expenses, you debit salary account. If the business pay wages, if the business pay electricity, their expenses, and all those accounts will be debited. Why? Because it's increasing. If the business purchase assets, You are adding assets. What do? You debit asset account because asset is what? Increasing. If the business increase sales, if sales increase, which is income is increasing, what do? You credit sales account because income is what? Increasing. If the business is having more payable, like you are buying on credits, that is increasing your liability. Abi? So what do to liability account? Is increasing, by so doing you credit it. So it's just a short principle that just cram it. That's the advice, cram it. As you cram it with time, everything will now be getting clearer. Oh, that's why we credit, oh, that. Then the last one there is a CADE. The C there is credit expenses. Just the opposite. It's just the opposite. Credit expenses and assets. When they decrease, why the DEL means debits, income, and liabilities. When they what? Reduce. So the first part is increase, the second part is what? Reduced. Am I making sense there? So these are basic principles that I want us to know in this first section of this class, which is more like a review of what we have been doing or what we have done so far. So if there is no question on this, I would like to also cut the video on this. Then my next video now will now be on, I'll go to control account. I'll go to control account on my next video. And then when I finish control accounts, on the principle of control account, we'll now start looking at past question. Then before I go to depreciation, look at past question on depreciation, so that we know that from next class, we'll focus on partnership, and we'll just have a quick review of everything. This review is not going to be once, you get ahead, but let's quickly just clean up the first phase, clean up the second phase, before the third phase there might be exam, and you are good to go. Okay, thank you. So I'm ending the class, but please don't go, stay behind so that we can continue again.